Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly walk through all the latest and greatest with regards to the mortgage industry. Each week, I'm pleased to be joined by one of our lender members as my co-host. And this week, I think your fourth stint in the co-host slot, fellow Clevelander, fellow Cleveland Browns fan, president of Nationwide Mortgage Bankers, my good friend, Jodi Hall. Jodi, thanks for joining me.
Thank you. Thank you for having me. I feel like there's less turmoil in the market for this last week in mortgages as there was the previous two. I think this might be the third. I'm not sure.
Yeah, it seems like whenever you're in the co-host slot, like some major chaotic news breaks like the day before. But I don't know, maybe keep an eye on the news scroll as we go through the program here. So
topics may change.
Yeah. As always, any questions, comments, thoughts, anything that any of our attendees want to incorporate into the program, don't be shy about pumping it into the chat or the Q&A, and we'll incorporate it into the show. So, Jodi, as much as I'd like to start with the Cleveland Browns, we'll keep it to the mortgage industry. How can we not start with, the latest from FHFA and the latest in what has been a really aggressive series of announcements, releases, proposals by the Biden administration through FHFA, CFPB, HUD. The latest being a proposal out there for industry comment for the next 60 days related to a pretty aggressive expansion of goals on minority housing in terms of units purchased by Fannie and Freddie. Also low income and very low income census tracts, and it's been almost every week something new. We had the news on the being able to use rental payment the week before. Just a day or so ago, we got news that down payment assistance is part of the infrastructure package. So, and it feels to me, you as a fellow Clevelander, we know Marcia Fudge has been a fierce politician here in Northeast Ohio for a long time, very fierce advocate for her constituents now being housing in America. And just read through the news of like her being out on the infrastructure kind of road show. She's speaking about two things primarily. One is protections for renters and mortgage holders affected by the pandemic. But the second is just people in need of affordable housing. And it feels like her fingerprints, even though she's the HUD secretary and this is an FHFA announcement, are all over this. So your thoughts on the latest from FHFA on expansion of housing goals?
So I kind of feel like this is old news, being that we knew, Biden was stating when he was campaigning that he would try to increase affordable housing for minorities. So we've been talking about it. I think we're just starting to see the structure and what the future may look like for affordable housing. The objective is to create equitable, affordable housing that reaches low and moderate income families, minority communities, rural areas, and other sort of populations. And I thought that it was interesting, and I actually have to read what the objective is, because I think it's going to put some more pressure on us as lenders to know who we should be lending to. And it says that they tell us specifically that they are going after the minority census tract, which is the income below the area medium income, and the property is in a census tract where the medium income is below the AMI, and minorities make up 30% of the population. So I think we really need to get direction on what those specific areas are. I think that with the combination of FHFA and HUD joining forces for enforcement, that we are going to have to market to those areas. The benchmark for FHFA is to increase what is considered the minority census tract. In 2018 to 21, they were to hit 24% of that group, and now that's going to be increased to 28%. And what's interesting in all of that is what was one of our first conversations in Trending Today when FHFA came out with the PSPA layered risk directive that only 6% of purchases and 3% of refinance transactions sold to the agencies could hit 2 of 3 of the risk factors, which was exceeding 90% LTV, the back end DTI of greater than 45% and FICO scores lower than 680. So, what percentage of the target segment are they trying to reach because most of them will hit 2 of the 3 risk factors. And as of September the 18th, the average median score that will be used on DU for qualifying purposes is the average of the 2 medians to get more borrowers over that 620 threshold, but that will add to the number of borrowers who have that layer of credit risk. So I think we knew where the administration would be going. However, we still are getting mixed signals as lenders as to what direction we're going to go. I don't know about everyone else, but we're not promoting the refi now and the refi possible that's coming out this week, because we had reached out to both Fannie and Freddie and they said, you're still within those constraints. And many of those loans fall within those parameters of layered risk. So it's a juggling act, and it seems a bit confusing in lending.
I mean, think about it. Just a few months ago, leaders like yourself were reacting to implementations from the PSPA amended related to non-owner occupied properties. All the tea leaves were pointing, with the pending Supreme Court case, in the direction of the 2 of 3 rule that you just mentioned being implemented, where borrowers had 2 of 3 risk factors. You can only sell a very small percentage of those units to Fannie and Freddie. Now it feels like almost certainly we're going in the complete opposite direction, where in order to achieve the housing goals that are being put out there by the Biden administration, all the PSPA amendments would have to be eliminated, and we're going to see expansions to the book of business that Fannie and Freddie are going to buy. And like you said, your Fannie and Freddie reps are still working towards and solving for the PSPA amendments, because that's the legal document out there that is formally directing Fannie and Freddie.
Yep, for sure. And I think that's where a lot of the comments need to go, is like, all right, like, great, we'll play by the rules, but can we have one set of rules, and can the rules not contradict each other? And I think that there needs to be clarity around that. Now with the investment properties and the and second homes, I understand why those rules were put in place, and I don't think that any of the new commentary from FHFA is contradicting that. But I do think that with affordable housing and lower income borrowers, that we very much are contradicting it. You talked about the rental payment history, you being a positive only factor to help qualify borrowers. Like, that's like the first common sense thing I feel like we have heard in a long time. When I came into the mortgage industry more than 2 decades ago, we used positive rent. If the borrower could document their rental history and they were paying on time, that was a compensating factor we'd use. We use that today when we look at government loans that have layered risk, and using that as a compensating factor to overcome that risk in our government loans. And it's like, okay, so Fannie Mae is catching up on that one. So I think that part is positive. And when you look at home buyers or renters who their largest expense that they have is their housing expense, that's a huge portion that isn't taken into consideration today, and can be a huge determining factor in that borrower's ability to repay, or even having, the willingness to repay their mortgage debt.
And as you mentioned too, lenders are going to have to get a lot smarter about knowing the demographics of the markets that they lend in, where their loans are coming from, what the mix of their closed loans and pipeline looks like. And I think that, and there's a lot of new data providers in the mortgage, and it's a trend we've seen. We kind of get approached by all the new vendors that are coming into the industry, because they view our network as a way to kind of get going. There's been a lot of data providers in general. I'm sure you've been getting those same calls as well.
Yep. Yeah. Calls, emails, LinkedIn messages, everybody's selling something.
Right. They are. So, but I remember like working for banks, and some of our bank members that I see in the audience can attest, like, and being held to CRA responsibilities and fair lending audits getting big printouts of like census tract maps and understanding where our physical branch locations were and our obligation to lend. Somebody made a good point, one of the newsletters that I read this week, though, but it seems to be trending towards like independent mortgage bankers having to comply, if not with CRA, but with the same fair lending audit requirements that depositories have to. But the author, and I can't remember if it was Chrisman or somebody else, made a great point. Like, the reason that banks have to comply with that is because they get access to FDI insurance in deposits that they take in those communities. And the whole premise behind CRA is, listen, if FDIC is insuring your deposits in the communities where you have branches, you have an obligation to lend money through loans in those locations. But it's a different ball of wax for independent mortgage bankers. They don't have that luxury.
Yeah, the other issue is it's based on the branches that we can recruit. I come from one of the most rural areas in Ohio where I grew up, and I can tell you, if we don't have a physical location in those communities, people aren't willing to do business with you. They want to do business with people that are local. And we're going to be hampered by that. We can do marketing, through consumer direct channels to have someone who covers those areas, but it's not going to have the same impact in different areas as having that physical location and having those smaller credit unions and banks that are in rural communities specifically.
Yeah. And, going back to Marcia Fudge as HUD secretary, a very effective and serious politician. And, one of the first headlines to break, these last few weeks, just regarding changes, you mentioned it earlier, was an alignment between HUD and FHFA for more strict enforcement of Fannie and Freddie to hit their housing goals. So, but to your point, everything is so much more remote now, right? It's nationwide mortgage bankers based out of New York. You are hiring people all over America now. I worked for a bank in Cleveland. I was hiring people only within an hour of physical locations we had. So it was easier to hold, in that old world, lenders responsible for making loans that looked like the demographics of where their brick and mortar was. But now with everything so spread out, will lenders be held to one general standard regardless of where you are? Will there still be regional aspects to it? So hard to understand how they're going to enforce lenders' obligations to make loans to different demographics and different borrower types.
Yeah, exactly. And, we're 55% New York and New Jersey and high income areas. And it's going to be very difficult for us when your average loan size is near 400,000 to try to break into markets that you aren't currently in. So it'll be interesting. They'll give us an overnight to figure it out.
There has not been a lot of foreshadowing or advance notice on some of the changes dealt to the mortgage industry as of late, and it'll be interesting to see how they handle all the changes sure to be coming going forward here. So
for sure.
This is the last week in Mortgage Today. I'm Rich Swerbinski with the Mortgage Collaborative, this week joined by Nationwide Mortgage Bankers President Jodi Hall. Jodi, moving our attention to a different topic, PMI taking even more business from FHA in Q2, most certainly due to just tighter Govy guidelines during the pandemic. You seeing the same at Nationwide?
Mm-hmm. Yeah, absolutely. I think it's partly due to government guidelines. I think it's also due to the FHA bidders losing out when they're bidding on properties, because it's seen as a negative when you have to check on the purchase contract that you're doing a government loan. VA almost getting zero attention. So I think part of it is that, our FHA bidders in the housing market are losing out to conventional home buyers. I also think that with the increase in FICO scores in general, so the average FICO score for FHA is a 675 and 750 for a conventional And the average LTV also for FHA is 95%, and it's in the high 80s for conventional. So I think that, it's just more targeted to the conventional base. Credit scores have continued to rise in the pandemic. When the economy struggles, FICO scores rise, and the 2020 average FICO was 703 by October. It was 711. That was Experience FICO data. So more borrowers are qualifying for conventional loans, and we're seeing that at NMB. Last year, 71% of our loans were conventional loans, which was historically high for us. We did 4,413 conventional loans. And then this year to date, we're 75% conventional, have already done almost 4,000 conventional loans for the year. So we're increasing market share, but we're also have an increase in the number of conventional home buyers as well.
And the data we're seeing through TMC benchmark broadly across the network seems to indicate the same. Seems like a good time to be a mortgage insurance company now, with just credit quality up, and a bigger share of business and homes appreciating. That is the ultimate good thing for the PMI companies. So another interesting news story that broke this week related to just inventory in general and existing home sales. I think we're finally now starting to see a shift. The last time you co-hosted this show, and just been talking about it on this show all spring, the exploding home values, the lack of inventory. Starting to see a reversal of that now. National Association of Realtors put out a report this week. Total inventories in July up 7.3% over June, not an insignificant increase, and up 28% over the lows that we saw in the winter. Still down 12% year over year from last July, but more homes clearly on the market. The average home listing price fell for the first time in a long time from $363,000 to $359,000. And then we also got existing home sale data. Existing home sales had dropped like 4 or 5 months in a row, like into the heart of spring and summer. We never see that in this industry. And finally, a reversal in July, 6 million existing home sales, badly beating estimates for the positive. So feels like a little shift in the housing market, more homes on the market, listing prices starting to come down, all those sideline borrowers starting to sneak off the sidelines, no?
Yeah, depends.
A little.
So the housing inventory, we see for higher priced homes, we see that the prices are easing, but in those low tiers for affordable housing, it's still extremely competitive. So kind of depends on where your demographic is, what you are seeing. It all comes down to supply and demand. We saw in 2020, there were 2.38 million first-time home buyers. That was the greatest number of first-time home buyers since 1999. So we really are seeing, more demand than there is supply. And, that leads into lack of new builds because of constraints in the supply chain. It also, another topic we want to talk about is, existing home buyers feeling stuck in the places that they are. So it is good news. There's still a lot of homes out there for sale, like 600 and some million homes that are on the market. I'm sorry, the 1.32 homes are still on the market. Like, there are houses, but it's where do you go? What do you do? And I think that's largely limited to because home buyers are just like, hold on. If you're already in an existing home, like, I would love to take advantage of the price of homes today and sell my home because I plan on selling in the next 24 months. But if I sell my home, where am I going to go?
And good point. You brought up, I think it was Digital Risk put out a survey, results of a survey this week. 53% of existing home buyers feel stuck in their home because they can't afford the next home up. So to your point, a lot of people that would love to take advantage of home values now and sell their home, but you got to go somewhere, right?
Yeah.
And typically when people sell a house and buy a new one. It's something nicer or better,
Yep.
in most cases. And but to your point from earlier, though, that's where we're seeing the home prices that have really shot up, and there still is a dearth of affordable homes in America despite the improved inventory numbers.
I think it's where the inventory is available too. We see that home buyer, now that there is so much remote work, where individuals can move out of high rent areas or high housing prices areas to lower. The inventory isn't there in the lower markets because everybody has been making that move now since the beginning of the pandemic to more suburban and rural areas. So I think that affordable housing is what is lacking. We see the high, above $1 million, there's a huge amount of inventory, but most people can't afford that. And people who are in existing homes, they really feel like they're house rich and cash poor. And, there's still uncertainty with, I'm not my increase in pay is not happening at the same rate as home prices. If I move into a larger home, what are my maintenance costs going to be? Can I get maintenance done? Because we hear the, miserable stories of dealing with contractors in this day and age, or even having, if I was talking to a friend of mine here locally, and they had a garage door that was damaged in the beginning of the pandemic last year, and they haven't been able to get a garage door. So I think that there's a lot of like, all right, I may have a lot of equity in my home. I may want to move, but I need to wait and ensure that I have a job, that I'm going to get increased compensation, and that hopefully I'll be able to step up into a house 12 months, 18 months from now, without having increased inflated housing prices due to the shortage in the market.
And that's another, I think, factor that is somewhat impacting the purchase market a little bit right now. It's just a lot of movement. We were kind of talking about it before we went live. I've seen just so many surveys and reports. So one of them I read yesterday was 65% of Americans are considering a job besides the one they have. That is a astronomical number to me. And has to be starting to permeate. I mean, our industry can't be insulated from that, right? And you're starting to see more movement. And
definitely some people that I talked to a couple of years ago about making a move, like people that I forgot that I talked to 2 years ago, are starting to reach out. And there's a lot of people that are looking to make moves. We had a couple of moves within our organization that were unforeseen. And I hope it's not, indicative of what is to come. You feel pretty secure with the data that we've gotten from, top workplaces, but people are talking, that's for sure.
yeah, it was like, the pandemic hit and just that flurry of like, oh my God, I'm happy to have a job, and I'm working from home is great. And then, now it's like, people have had a lot of time to be at home in their home office, where it's, I think companies have done a better job, not just in our industry, but broadly, but marketing and, recruiting people digitally and through, different social media platforms and job sites. So, by all indications, we are just going to see a historic amount of job movement, forget the mortgage industry, just broadly in America. And to your point, people can move kind of anywhere. I had Keith Canner, our friend from First Community Mortgage, was co-hosting this show last week. They're based just outside of Nashville. He said the explosion of people that they're getting moving to the Tennessee area from like California and the coasts is like, it started in Nashville, and it's just like building out outward, because Tennessee has some favorable tax policies. The weather's pretty good. There's some fun places there. You're seeing just a shift of people from employer to employer, and then also location wise across the country.
Yeah, it's going to be another interesting 12 to 18 months, I would say. Maybe we'll get next summer, hopefully we'll be talking about beginning of next summer, some commonality, consistency, going from needing to hire the greatest number of people because of production. And hopefully it's not that we need to hire the greatest number of people because of what are they calling this year? The Great Resignation.
Right, the great resignation. So, yeah, it should be interesting. All the while technology continues to emerge in the mortgage industry, that's just going to change, not eliminate the human factor, but certainly lessen it to some degree, especially in the mortgage loan manufacturing process. And it's just going to be very fascinating to see how that all kind of comes together. Never a dull moment in the mortgage industry.
For sure.
Another interesting note this week: private label securities, a big jump up in the second quarter. These are non-Fannie and Freddie conventional loan bonds, but financial institutions that are creating private label securities essentially to package and bundle securities of loans and then sell out in the open market. Things like unconventional income sources and DTIs that make the loans non-QM, but they're still good loans. And I think it was only 4% of total securities issued in Q2, but a big jump up. And I think that again speaks to overall good credit quality, a tighter credit box for the agencies, at least right now. And then, anytime you have opportunity, people find a way to exploit it. And I think you're starting to see a little bit of that in the PLS market right now.
Yeah, I definitely think it also increase in home prices, and I feel like there was some uncertainty, wondering what was going to happen, if the bubble was going to burst again. And I think that people see that with the tighter restrictions on conventional lending, that we're likely to continue to see the increase in home prices, just not at the same speed as it has been over the last year. I also think with historically low interest rates, there is value to be had. So there's less risk of the prepayment. And we talked about this too when we first heard about the PSPA and how the limiting of the investment in second homes. And we were wondering if there were going to be more private investors that were coming into the market to purchase those. They're really good loans, right? You have borrowers who have the history of owning investment properties for many years and multiple investment properties. There's good loans to be had and to be made. And the same in the non-QM space, where we saw a lot of the non-QM investors pulling out at the pandemic, starting to make the move back into. And I think it's just to open, more loans to be had and less risk is making people feel really comfortable and enter more into that private labeled securities arena.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative and have a couple minutes left with Nationwide Mortgage Bankers President Jodi Hall. Jodi, you mentioned just supply lines in general for the mortgage industry. It's hard to, it feels like, the fact that the housing in America has been underbuilt for, depending on who you talk to, between 5 and 10 years. And then we've had just this kind of crazy pause right now. Any home builder stats or surveys, just indicate that, due to supply line shortages and buyers not willing to pay the astronomical prices to build a home this last year and a half, further slowdowns. And you talked about just the dearth of affordable housing in general in America. Forget total supply and total inventory, which is getting better, but is still way low. On the affordable side, builders aren't building $100,000, $150,000, $200,000 houses. How is this going to play out? It's a very open-ended and brutally tough question, but I worry and wonder about that in general as we move forward.
I don't see, unless, some of the proposed stimulus package for infrastructure is going to builders who build in the lower, I don't see it changing. If you're not going to build, $10,000, $100,000 homes, you're going to build $1 million house because you're going to need, you can't find a contractor. Was on with a builder to start building in February of next year, and his framer, it was a independent builder, his framing contractor left, and his plumber left him. So what are you going to do? Like, you can't, the time and resources it takes to build 10 houses versus one, unless there is some financial reward for building more affordable housing, I don't see what the end game is. Unless it is that, you know, people feel more comfortable about what's going on and they want to move up. So existing home buyers start buying new homes because they feel more secure in their jobs and in the income that they have outside of that. And can most people who are at a position to afford a more expensive home are the empty nesters who are looking to downsize the home that they're currently in. So they don't want $1 million house either. So it seems like it's revolving, and I didn't see anything in the $3.2 trillion housing proposal or infrastructure proposal that was going to help or incentivize builders to build affordable housing.
Yeah, I mean, it feels like it's going to take government intervention to fix the problem at some point. And, you know, you could expand the credit guidelines for low income and affordable housing candidates. You can expand Fannie and Freddie's goals and the enforcement of how many units they have to purchase that are affordable housing units. But if you don't have the units, then at the end of the day, it's going to be tough. But it's the most complex of all those. And, you know, and it kind of feels like maybe that's where the Biden administration and Marshall Fudge is going to be going next, you know, once they knock some of these other dominoes down. So
for sure.
Excellent. Well, Jodi, as always, appreciate you joining me this week again, and always enjoy the conversation, and go Browns.
For sure. And before we leave, I need to put 2 plugs out there.
Okay.
So our last weekend mortgages, we found out the Inc. 5000, we were named the 3rd year in a row fastest growing mortgage company across the United States. And the number 6 Fortune Best Small and Medium Workplace, which is fueled by the Great Places to Work data. So that was our last week of mortgages, very exciting. And also August the 28th, 12:30 on Fox Business News, Nationwide Mortgage Bankers will be aired as the feature story on Trending Today.
No way, that is super cool.
So please, everyone, tune in. Appreciate your support.
That is awesome. Congratulations. And yeah, you guys have done some really great things, especially these last couple of years. And NMB was a TMC member, like way back in the day. I was kind of a disengaged member, and you called me one day and said you were pursuing an opportunity with them. And it's been really, really cool a couple of years watching all the great things that have happened there. So
it's been a fun ride, and I appreciate TMC's support, and I'll see you all in 25 days.
25 days, Terania. Jodi will be leading a few different sessions for us out there, including one we're doing on Sunday afternoon, really focused on the current state of the mortgage industry. Her, Rob Krisman, Kirk Willison from Arch, Sarah Gonzalez from FGMC, really dynamite panel of people, kind of to really get conference kicked off Sunday afternoon, a very interactive roundtable discussion of our members on just the insane last 18 months that the mortgage industry has gone through, and what could be looming around the corner as we move into the latter part of 2021 and into 2022. So, and as always, for our attendees, thanks for spending 30 minutes of your time with us on Tuesday afternoon. We are here every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. And until next week at that time, have a great rest of the week, everyone. And Jodi, thanks again. Take care. Have a great day, everyone.